All right, we're going to finish up our talk about cash management and banking today before we move on. And if you recall, cash management and banking is the lowest level of investment, security that you'll have out there. Now, yesterday we kind of focused on what the advantages and disadvantages and what types of accounts. But before you consider, and remember yesterday I did talk about you had to have goals before you could consider investing, so you know what you're investing for. What are some things you should consider amongst those cash management and banking alternatives? And that's kind of what we're going to look at today. When comparing cash management alternatives, it's critical to understand and accurately compare the following 5 areas. First off, accurately compare the interest rates. And sometimes that can be a challenge because one bank might say our annual interest rate, another one might say our quarterly interest rate, our monthly interest rate, and you have to know how to translate all those things. So certain cash management assets are compounded annually, others are compounded quarterly, and still others are compounded daily. But if we use a consistent method of comparing interest rates when considering cash management alternatives, then we can compare these a lot better. Now, the good news as consumers of financial services is that the Truth in Savings Act of 1993 required all financial institutions to report the rate of interest using the annual percentage yield, or APY. And the APY converts interest rates compounded for different periods into comparable annual rates and allows you to easily compare interest rates. So the APY, the formula for it is 1 plus the APR divided by the number of periods multiplied by the periods minus 1. So financial institutions are required by law to state the APY of different savings vehicles, which converts the different interest rates into similar compounding periods. You also, the second area, have to be able to compare after-tax returns. Some things you have to pay a lower tax on than others. And so, and some things you have to pay a higher tax on than others. And so you have to know, okay, well, how much am I going to be making after taxes? So while certain assets may have lower returns, these same assets may be exempt from state and local taxes. They might also be exempt from federal taxes if they're used for college tuition, such as the Series EE and Series I bonds we spoke about yesterday. So consider tax advantages and after-tax returns, and remember the after-tax return equals your taxable return, the reported APY, times the result of 1 minus your marginal tax rate, the tax rate of each additional dollar of earnings. Your after-tax return is going to equal your before-tax return times 1 minus your marginal tax rate then. And your marginal tax rate equals your federal marginal tax rate plus your state marginal tax rate, if any, plus your local tax rate, if any. So if any of the cash management assets have tax advantages, meaning they're either federal or state tax-free or both, calculate the equivalent taxable yield, or ETY. The third area you have to consider is taking inflation into consideration. And remember, it's not what you earn, but what you keep after taxes and inflation that makes you wealthy. Calculating the return after inflation, or the real return, is important. The real return is calculated using the following equation. The real return equals 1 plus the nominal return divided by 1 plus inflation minus 1. And if inflation is a concern for you, there are inflation-linked bonds that we talked about, the Series I, for example, or U.S. Or Treasury inflation protected securities, which are T-bills that are tied to the inflationary rate, known as TIPS, that take changes in inflation into account to determine yields to protect your money against inflation. The fourth area you need to consider is the safety of the investment. What is the risk that you might lose it? And some investors consider all deposits at financial institutions to be safe because they're insured by the government. However, some banks and other financial institutions have historically made decisions that are not consistent with proper fiscal responsibility, and some investor deposits have been lost. The FDIC and the NCUA insurance are available for up to $100,000 per depositor. So if you have $100,000 in your checking account and you've bought $100,000 in CDs at that same financial institution, that same bank, well, if they go under, you're only getting $100,000. That's it. So it's not per account. So if your assets are greater than $100,000 and you want more insurance, deposit your assets in multiple federally insured institutions. And although MMFs are not insured, they may be invested in a diversified portfolio of government bonds with the explicit government guarantee of repaying that debt. So these bonds are guaranteed by the government. And MMFs may also be invested in short-term corporate bonds, which generally have very little risk because their short-term businesses don't usually have problems in paying those as opposed to paying long-term debt. A certain degree of safety exists because of this broad diversification in a mutual fund, and because this debt's very short term, often less than 90 days. So while there may be some concern for safety with MMFs, it's not generally a major concern. Now, the last area you should consider is maturity and interest rate adjustment periods. And when considering cash management alternatives, you always need to consider the maturity of the investment. And by maturity, we mean how soon can you access and liquidize the asset and get money, cash out of it. So some of these assets require the investment to be held for a minimum amount of time. For example, CDs, triple E and I bonds, you actually have to hold for a certain period of time before you can cash them out without penalty. And in addition, consider how the interest rate could change and the potential impact of those rate changes on your financial situation. So in summary, your choice of cash management asset depends on those 5 areas. First, your goals and risk tolerance. What is the purpose for this money that you're investing? And we talked about that yesterday, that you really can't just invest money. You have to know what you're investing your money for, what the goals of that money are going to be, because that's going to determine what investment is a wise investment for you. Second, the type of asset you prefer. Are you investing in CDs, MMAs, money market accounts, MMFs, money market mutual funds, or savings bonds? Third, your tax situation. What is your marginal tax rate and how will this investment affect your tax rate? Fourth, the location of the financial assets if they are municipal securities. A municipality is a local government entity, and sometimes they need to borrow money. They can't print it like the federal government. And so they will sell bonds, IOUs, to raise that money. A lot of returns on municipal bonds so that you'll invest in your community are state tax-free in the state that you reside in if you're buying the municipal bond from the state in which you reside in. So if I lived in Indiana and I bought a bond from Marshall, it wouldn't be written off my Indiana state tax return. But if I lived in Illinois and did the same thing, it would, because Marshall is in Illinois. Are they municipal bonds from your state or from another state? And is there a state income tax from your state? If there is, you usually can write this off. I know some older investors who have taken, their retirement funds because they're getting older and they just want to protect them and not pay taxes on them, that will put them all into municipal bonds. And then they don't have to pay state or federal tax on the return they're getting, and they just live off the return. And fifth, your use of the funds for savings bonds. Is the principal and interest going to be used for tuition at a qualified school, college, university? If it is, you can write it off. And so you get a tax benefit, a tax advantage from that. So these are the things that we need to think about when comparing these cash management alternatives. And it's critical to understand and accurately compare those 5 areas in making that determination. Now, there are many different types of financial institutions that offer the various cash management alternatives that we've just discussed. The distinction between which services are offered by traditional banks and which services are reserved for non-bank financial institutions has been blurring since the 1980s when they started deregulating the financial industry sector. So now a place like State Farm Insurance can offer banking services, whereas the bank might be able to offer you insurance sales services or investment services. So there are 2 major types of financial institutions, basically. There are banks, what we call deposit type financial institutions, and non-banks, what we call non-deposit type financial institutions. And the choice of which institution you use depends on which institution will serve your needs the best and help you achieve your goals the fastest. So deposit type financial institutions mainly fall under the 4 classifications: commercial banks, First Financial, the KZ State Bank, the Preferred Bank, savings and loan associations, which you really don't see a lot of those anymore. credit unions, and internet banks, where you only use the internet to engage your account. So commercial banks generally compete by offering the wide variety of services. They're usually the local ones, like the 3 banks I mentioned here in Marshall. However, they generally do not offer the highest interest rates on deposits or the lowest interest rates on loans. Savings and loan associations have slightly different ownership arrangements than banks, but they're similar to commercial banks. Savings and loan associations may offer slightly higher rates than commercial banks on deposits and somewhat lower rates than commercial banks on loans. Savings and loan associations are usually locally held establishments. And I'll be honest, there was a huge scandal, savings and loan scandal in the 80s. And I rarely see savings and loan associations anymore. I can't think of the last time I've seen a savings and loan association. So those might be a little bit harder to come by. Credit unions, though, are very similar to savings and loan associations, and you'll see them a lot. And credit unions are based that it's owned by the membership, like a savings and loan, but the membership is usually from a qualified portion of the population, such as the teachers' credit union. You have to work at an educational institution to be a member, for example. So credit unions, very similar to savings and loans associations, but they are not-for-profit organizations and are owned by their members. And they can sometimes offer higher rates on savings accounts and lower rates on loans because they're not driven to provide a profit to shareholders. Internet banks are fairly self-explanatory. They're electronic banks. They don't have traditional brick and mortar branches. Because they have fewer branches, employees, and capital expenditure, though, than traditional banks, they can generally pay higher interest rates on deposits and charge less for loans than traditional banks do. Now, the second category, the non-financial institutions, the non-bank financial institutions, consists of 2 main kinds. There are mutual fund companies, and with many mutual fund companies, you can now write checks against your mutual fund account. Now, let me take a couple seconds here to tell you and try to explain to you what a mutual fund is. Because when it comes to investing at the higher levels, when we get into equities and bonds and things like that, mutual funds may be your best bet. If you invest on your own, you have to take the time to research every stock, every investment in detail. And that could take hours. And a lot of people just don't have that time to put into managing their portfolio. But if you pay an expert to do it, then certainly that frees you up the time and you don't have to learn all the ins and outs of the industry and what's going on and follow the daily financial news on that industry or that company. The expert will do it. Now, you could certainly pay an expert for his advice and then just buy the investment, but actually that's going to be more costly and more time consuming as the expert explains to you why he's doing what he does, as opposed to just buying into a mutual fund. So for a lot of novice investors or people who just don't have the time to put into understanding or dealing or managing with their investments, a mutual fund is a great way to do this. Because what you do, and I gave this example yesterday, if a mutual fund has 100 investors who gave $1 and they buy $100 in one Apple share, then everybody owns 1/100th of the Apple share. Now, a mutual fund will, certainly buy a lot more different stocks and things, so they'll have a diverse portfolio. And if one stock goes down, the others will, stay up, or some of them will even go up even higher to kind of offset it. But if you're a single individual and you buy that stock, usually that's about all you can afford is that one share of stock. And now you're stuck. If that stock goes down, you lose everything. So the mutual fund gives you some advantage there as far as the diversity as well. But mutual funds are basically an investment vehicle that is made up of a pool of funds collected from many investors for the purpose of investing in securities such as stocks, bonds, money market instruments, and similar assets. Mutual funds are operated by financial experts called money managers, and they invest the fund's capital and attempt to produce capital gains and income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in the prospectus. And a prospectus is a formal legal document which is required by and filed with the Securities and Exchange Commission, the SEC, that provides details about an investment offering for sale to the public. In other words, back in the old days, people would come to you and say, I got a great investment for you. Let me tell you how wonderful this is. And all you really had to go on was based on what they said or what your friends were saying about it. And hence why you got things like Ponzi schemes. But certainly after the 1920s, the great Ponzi and his scheme and the formation of the SEC, laws were passed that now institutions have to, on a regular basis, quarterly, some cases annually, and others, provide you with specific financial information about that company that you can then use to judge, is this a good investment or not? Now, a part of this was the company had to print something out called a prospectus, which with all this information to give to you. The trick with prospectuses today is companies go all out to make it nice and glossy, to really sell themselves. So in a way, you kind of have to know what you're looking for to pull this information out, because otherwise it just looks like a great advertisement for investing in that company. So even now with a prospectus, you should be careful and try to maybe even use the experts, which is why I highly recommend a mutual fund. So a prospectus should contain the facts that an investor needs to make an informed investment decision, though. So one of the main advantages of mutual funds that I've already talked about is that they give small investors access to professionally managed, diversified portfolios of equities, bonds, and other securities, which would be quite difficult, if not impossible, to create with a small amount of capital. So unless you want to buy the $100 share outright, rather than only having $1 to spend, or think of it, if you want to buy 500 shares of Apple, it's going to cost you at today's rate probably $10,000 to do so. Whereas if you join a pool of investors, you'll own less shares of Apple for less money, but you'll still own Apple and get the benefits of that. So each shareholder participates proportionally in the gain or loss of the mutual fund. So if the mutual fund owns 100 shares and you own 2 shares, you own 2% of the returns of that mutual fund. So mutual fund units or shares are issued and can typically be purchased or redeemed as needed at the fund's current net asset value, meaning when they divide all the shares by the amount of money that they have, that's how much your share is worth. And it's sometimes expressed as NAVPS, the net asset value per share. Brokerage firms are another type of company, and there's a couple of brokerage firms even here in Marshall. There's a couple of Edward D. Jones offices, but they've also gotten into the act, and a lot of them can now allow you to write checks. They issue credit cards and ATM cards, and they'll even make loans. Brokerage firms offer these and many other account features that were once reserved only for traditional banks. But both banks and non-banks offer online financial services, and these services allow you to access bank balances and other resources 24 hours a day. Now, with the blurring of roles between deposit and non-deposit institutions, banks can now offer investment services, and non-banks can offer check writing privileges, credit cards, and savings accounts. So you have a lot more options available to you. But choosing a financial institution is a challenge. The key is to consider what you want to accomplish, again, your goals, and then to consider what the financial institution can provide. So, what do you look for in a financial institution? And your choices should ultimately and most importantly reflect your understanding of yourself and your investment needs. But consider these questions when making that choice. Are you looking for low costs, low fees, and high returns on deposits? Who isn't, in a way? But if you're looking for more security and not necessarily a high enough return, but just to protect your money against inflation, now you have to make a choice here. What services are important to you? Is it important to you to have someone face-to-face you can meet with on a regular basis that will walk you through things? Or is it more important that you have check writing services, or that if you have overdraft protection, things like that? Do you need loans, mortgages, or working capital for a small business? How important is safety for your deposits? Do you require government insurance? And if so, know that this factor limits the type of institutions you can choose, because normally the only ones with government insurance are banking institutions and credit unions. What services does the financial institution provide? And if all you require is a high return on your assets, then your choices are much broader. Just know that the main goal of cash management is to give you sufficient liquidity to help you achieve your financial goals. And only you can determine which goals are most important to you to accomplish now. That's going to be on an individual basis. But please note that it is not required that you use only one financial institution to help you achieve your goals. They're businesses like anything else. And just because I buy, some groceries at Walmart doesn't mean that I can't go to Meijer and buy others, or IGA or something like that. Just because you get your mortgage and you have your checking account at First Financial doesn't mean you can't go to Preferred Bank to get a loan. You can use more than one financial institution, in other words, to take advantage of each institution's strengths as you go out to manage your cash assets. So that's all I had for today. Hopefully I'll see you guys on Tuesday, and we will pick up from there. Enjoy your weekend.